they've priced or underpriced commodities for so long that now you've got you have structural issues. I mean, take silver. Silver is in a structural deficit of what, 400, 500 million ounces per year. And if you could make the case that there's 200, 300 paper ounces for every 1 real ounce that exists. If silver goes failure to deliver, I guarantee you within 72 hours, so will gold. And when gold goes failure to deliver, the financial system as we know it is done.
The silver market is approaching a critical inflection point, one that signals deep-rooted structural stress rather than short-term volatility. The disconnect between paper silver contracts, which represent speculative trades rather than physical ownership, and the actual availability of the metal is widening at a troubling pace. A key indicator of this imbalance is the recent surge in silver lease rates, which have now climbed above 6%. Such a sharp increase isn't typical market behavior. It reflects growing scarcity and a reluctance among holders of physical silver to lend it out. Veteran analyst Bill Holter has long argued that silver's market value is fundamentally distorted. Despite facing a consistent structural deficit of 400 to 500 million ounces annually, the price of silver has remained suppressed, largely due to the dominance of the paper markets, where speculative contracts outnumber real, deliverable ounces by a massive margin. This setup has created the illusion of ample supply, but Holter warns that this illusion can shatter the moment someone demands physical delivery, and the metal isn't there. If that happens, we could witness a catastrophic failure-to-deliver event. Such a breach of trust wouldn't just shake confidence in silver, it could spread to gold and ripple across the broader financial system. According to analyst Bill Holter, the rising lease rates are a clear sign that major holders of silver are choosing to keep their metal rather than lease it out. That kind of behavior only occurs when there's real concern about future availability. This year alone, the global silver market is expected to run a deficit of over 117 million ounces, a shortfall that cannot be quickly resolved. New silver mining projects take 15 to 20 years to come online, and the industry currently lacks major developments in the pipeline. While some modest increases in output may be possible from existing operations, they're unlikely to cover the growing demand. Meanwhile, data from COMEX reveals that commercial institutions, including major banks, are sitting on massive short positions totaling around 12,000 metric tons of silver. Alarmingly, these positions are often held without corresponding physical backing. If the price of silver were to spike to $200 per ounce, while gold remained near $3,500, the historical gold-silver ratio would collapse, a move that could trigger widespread default across the precious metals market. Now, we present the clips from Bill Holter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
My opinion is commodities for so long now, since the 70s, 80s, have been controlled by paper contracts. Mm-hmm. And what's happened is they've overshorted contracts throughout the entire commodity spectrum. And, that's fine, except for taking into account the real world, real supply and real demand. So what they've done is they've priced or underpriced commodities for so long that now you've got you have structural issues. I mean, take silver. Silver is in a structural deficit of what, 400, 500 million ounces per year. You could make the case that there's 200, 300 paper ounces for every 1 real ounce that exists. Utility is not the right word, because think about all the uses for silver. I mean, you've got medicinal, industrial, technological. I mean, every time they launch a Tomahawk missile, that's a monster box flying through the air. The thing with silver is that there's end use for it. I mean, when gold gets bought, gold is money. Gold gets, like Warren Buffett says, it gets bought and then it gets put in the dark and you never see it again. The thing with silver is it gets used. I mean, it gets used, and yeah, you can get some of it back, but it's only some of it or a small part of it.
Yeah.
So the structural deficit, and getting back to the importance of silver, I've said all along, and I still maintain that silver is the fuse, if you will, to gold's financial bomb. Because when gold blows, when gold goes into failure to deliver, then you've got pretty much confidence across the world is going to collapse. Because, I mean, think about it. What's the value of a contract that cannot perform? The value is zero. So silver is such a small market. I think at current prices, you're looking at maybe 30 billion total production worldwide for a year. It's just such a small market in relation to gold. And you can't have silver exploding. You couldn't have $200 silver, in the short term. You couldn't have $200 silver and $3,500 gold. I mean, the ratio would completely collapse, and that would lead to a failure to deliver. If silver goes failure to deliver, I guarantee you within 72 hours, so will gold. And when gold goes failure to deliver, the financial system as we know it is done. The deliveries were made. It was said back then that it was because of the tariffs. I don't really. I think gold was being onshored or brought back. Another thing that's going on that almost no one's talking about is that you have foreign central banks that are demanding gold back from the Fed. And if you remember 10 years, 12 years ago, Germany requested, 320 tons or something like that. And it took them over 3 years to do it. And at the time, they were saying that, it's too much weight. It can't be done with Boeing 747 cargo planes. They can carry 95 tons each.
What if the U.S. government can't deliver the requested gold back?
That completely breaks all trust in the United States. Would you ever do business again if you were a foreigner? Would you ever do business again with the United States? And they've already come pretty close to that by sequestering Russia's $300 billion in forex reserves in treasuries. And now they're taking the interest from that $300 billion, and they've been giving it to Ukraine to fight Russia. The dollar would get smoked on that. I mean, there's no question about it. If you go back to just to get back to what I was just talking about, the Russian reserves, you go back and you look at a chart of gold, and you can see to the day, it was October of 2023, I think, when gold lifted off and came out of the range of the 1,700 to 2,200 or thereabouts. But the following day after that was announced that those reserves or those treasuries had been sequestered, gold all of a sudden kicked into, it started looking like a tractor in first gear going higher. And that is a function of trust.
Is there go ahead.
Foreign central banks just looked at that and said, hey, wait a minute, if they can do that to Russia, they can do that to us. We'd rather hold something that we actually hold, we know cannot go bankrupt, we know cannot be diluted. It's God's money. But I think we're going to go through at least one, maybe two resets before we get to the final reset, the Mother Nature reset. The first reset, I mean, there's no doubt in my mind that they're going to try to do some type of central bank digital currency or whatever, stable coin. It's still going to be fiat. And I don't think that that's going to last much more than, I don't know, maybe 6 months. Could be less than that. Could be a little longer than that. But I think we're going to go through a reset, and they will mark the price of gold up on that reset. But we're still going to have a fiat currency. And whatever the end result, as far as what the world reserve currency is going to be. It will be tethered somehow, ratio backed or whatever, to gold. There's no way that the world is going to accept the situation we're in now again.
Global debt has reached a historic milestone, soaring to $324 trillion in the first quarter of 2025, an astonishing $7.5 trillion increase in just 3 months. This isn't a minor fluctuation or a technical adjustment. It's a clear sign that the world's financial system is becoming dangerously over-leveraged. Such rapid growth in debt signals a deeper structural problem, one that can no longer be dismissed as temporary or cyclical. As borrowing balloons across governments, corporations, and households, traditional investment vehicles like stocks and bonds are starting to lose their appeal. Investors are sensing the shift and responding accordingly. There is now a visible trend toward tangible stores of value, as trust in the long-term stability of paper assets weakens. According to Bill Holter, this isn't just another debt cycle or a temporary dislocation. It's the early phase of a full-blown credit and currency crisis. The entire financial system depends on the belief that government-issued debt will be repaid and that currency will retain its purchasing power. But as U.S. Treasury yields inch dangerously close to the 4.5% to 5% range, that belief is beginning to fracture. A continued rise in yields could prompt foreign creditors to pull back from U.S. debt markets, triggering a cascade of selling that undermines the dollar's role as the global reserve currency. Meanwhile, the Federal Reserve and the U.S. Treasury find themselves trapped. Servicing this mountain of debt requires ever-increasing amounts of money that will likely need to be printed. But expanding the money supply to cover liabilities only works as long as people believe in the currency's value. Once that faith is lost, the risk premium on treasuries spikes, confidence collapses, and the dollar may have to be sacrificed to keep the financial system from imploding.
The Federal Reserve cuts rates, say they cut it 1%, 2%, and rates don't go down or go down very little. Or, in my opinion, ultimately rates are going to go higher rather than lower. That would break confidence. Now, in the real world, what does that mean? You're already looking at super soft real estate market, housing market across the country. Commercial real estate is already in the middle of a crash. Higher interest rates will smoke the real estate markets. Higher interest rates make it harder, more difficult to carry derivatives. And the world is awash. It's flooded with derivatives, and those derivatives are what price assets. You'll see derivatives begin to default, and then you get a cascade. And once derivatives default, you're talking about over $2 quadrillion worth of derivatives, which is way, way, way more than the value. It's probably double the value of every asset on the planet. So it'll be a paper bonfire, 100% guaranteed. I mean, you cannot have a sector of derivatives fail and other sectors not fail. And the reason being, it's one big, gigantic financial orgy where everybody's connected to everyone else. So if you get one entity that's infected, the entire system's infected. And understand that the problem with the derivatives chain, the way it's set up, is that if you have a contract between two entities and one entity wins, I mean, it's a zero-sum game. So one entity wins, the other entity loses. But if the loser loses so big that they can't pay, then the winner doesn't get paid.
Yeah.
Then whoever the winner is, whoever they're doing business with, they're going to say, hey, wait a minute, they got this big loss on their books. I'm not sure they're stable. So it spreads like that. And of course, the loser, they've gone bankrupt. So anybody who's doing business with them already, they become an immediate loser because the other side of the trade can't perform on that contract. And I've said for a while now that the ultimate goal is to get the entire earth under a central bank digital currency. Now, how do you do that? You couldn't bring that out today because the vast majority would say, no, I don't want to do that. But if you destroy markets and remember, when markets get destroyed, you're talking about banks, brokers, insurance companies, et cetera, going under. People, the great taking is going to happen. And when that does happen, people are going to beg governments around the world for a central bank digital currency and universal basic income that will, save the individuals. The only problem with a central bank and digital currency is that they can shut people down anytime they want. You and I, we do an interview like this after a central bank digital currency. Before we got off the call, you'd have nothing. Your account would be frozen. My account would be frozen. And all you got to do is look at the Canadian truckers to know the mindset as far as wanting to shut people off that speak ill of the official policy. People ask, when's the reset? And I just tell them, you're watching it in real time. I mean, think about this, Danny. Okay, so gold was $1,700 2 years ago. Now it's $3,400, double. Any asset that is the same price that it was at the end of 2023 has lost 50% of its value versus gold. Mm-hmm. And gold is the measuring stick. It's not the dollar. It's not the yen. It's not the euro, the pound, whatever. The measuring stick is gold. And that's why when people ask me, are we going to have inflation or deflation? Well, we're going to have inflation of the things you need, food, gas, etc., and deflation of the things you have. And the deflation of the things you have, not necessarily in dollars. You could see an asset, you could see a piece of property double in value and gold go up 4 times. And that thing that doubled in value has lost 50% of its purchasing power versus gold in that time. So gold is the measuring stick. What have central banks been doing for the last 2 years since the sequestering of the Russian treasuries? Central banks all over the world have been buying gold. That's about as inside as you can get.
Any other signals that you look for when it comes to gold and silver?
Because I believe that this has to be a credit/currency event. I think if all of a sudden you started seeing wild volatility in currencies, if you started seeing bigger volatility in or on the U.S. Treasury curve, I mean, this is going to be a credit/currency event. And if you start seeing, wild gyrations, or not even wild gyrations, just a movement upward. If you see rates go through 450 on the 10-year Treasury and you get a 5 handle or over a 5 handle, I don't think markets can handle that. And I think that would be a signal to foreigners that the game's over.
As global economic pressures intensify, gold and silver are poised for a significant upward trajectory shortly. Escalating debt levels, persistent inflation, and rising bond yields are undermining confidence in traditional fiat currencies and paper-based financial instruments. Investors increasingly recognize that the long-standing faith in central banks' ability to manage these challenges without destabilizing markets is waning. In this environment of growing uncertainty, demand for tangible, reliable stores of value like gold and silver is expected to surge. These metals have historically served as safe havens during times of financial stress, and their role is set to expand beyond mere protection to become key pillars of wealth preservation. With limited new supply and growing physical demand, the market dynamics strongly favor a bullish outlook. Share your thoughts on Bill Holter's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.